Welcome to This Explainer. This is a special presentation from the Praxeum, where we focus entirely on practical wisdom and strategic execution. We're all about analyzing how top-tier companies manipulate unit economics, how they navigate these incredibly complex regulatory frameworks, and ultimately, how they build massive, defensible moats. Today, we're diving into an absolute masterclass in business strategy. We're looking at exactly how xMoney built a regulated Web3 payments empire. It's a fascinating story, so let's just jump right in. $160 billion. Just let that number sink in for a second. That is the staggering, completely invisible toll booth paid by U.S. small and mid-sized businesses in credit card processing fees in a single year, 2023 to be exact. Every single time you tap your card for a coffee or click checkout online, a really complex web of financial middlemen is quietly siphoning billions of dollars straight off Main Street. It's often just accepted as the cost of doing business in the modern world, but make no mistake, it is an incredibly heavy one. Let's actually break down how this invisible toll booth builds up mathematically. This is a concept we call card scheme drag. So if a customer pays $100, the merchant obviously does not receive $100. First off, the card issuing banks take a cut for interchange, which is usually around $2.20 for things like rewards or cross-border cards. Then, the card networks themselves, your Visa or MasterCard, take a 30-cent scheme fee. And finally, the payment processors and gateways, thanks Stripe or PayPal, they take their acquirer assessment fee of about 70 cents. By the end of this whole gauntlet, the merchant receives just $96.80. Now, translating that math into real-world business pain reveals a pretty devastating reality. If you're a standard small business, right, operating on a really tight 10% net profit margin, losing approximately 3% of your top-line revenue to these payment networks doesn't just hurt. It literally destroys nearly a third of your total net profit. A third. And that's just the baseline. Exacerbating this pain are two other massive threats. You've got chargeback fraud, where buyers falsely claim a transaction was unauthorized. And then you have rolling reserves, where processors actually lock up 5 to 10% of a merchant's cash flow for up to 180 days, just to buffer against their own risk. It's a system heavily stacked against the merchant. So naturally, when Bitcoin and early cryptocurrencies arrived, the promise was completely revolutionary. It was this idea of a zero middleman utopia. Just cut out the banks entirely, right? But as we know, early crypto completely failed to fix this toll booth for merchants. They slammed headfirst into what we call the Web3 bottleneck dilemma. And this dilemma is defined by three catastrophic flaws: gas spikes, price volatility, and banking de-risking. Let's break these down using some everyday analogies so it's super clear. First, gas spikes. On early networks like Ethereum, you might be required to pay a $15 network gas fee just to process a $5 coffee transaction. I mean, it made low-ticket commerce literally impossible. Second, price volatility. Imagine a merchant accepting $20 in crypto for a pizza, but by the time the black actually confirms on the network 10 minutes later, the market swings and that crypto is suddenly only worth $18. Their entire profit margin is just gone. And third, arguably the biggest killer, banking de-risking. Unregulated crypto gateways still had to rely on commercial banks for fiat clearing. If a traditional bank saw your business account touching digital assets, they would abruptly freeze or terminate your account with zero notice. Which brings us to Act 3. And this is exactly where the strategic genius of xMoney reveals itself. Because instead of fighting a losing battle trying to operate completely outside the legal boundaries of traditional finance, they executed a brilliantly disguised Trojan horse maneuver. Their foundational strategy was simple but radical. Instead of trying to destroy traditional banking, they bought inside it. They realized the absolute only way to build a sustainable bridge between Web3 and fiat was to infiltrate the legacy system from the top down. So in 2022, the blockchain network MultiversX initiated a really brilliant mergers and acquisitions strategy. First, they acquired Utrust, which was a pioneering Web3 crypto payment gateway. But the absolute masterstroke, the real game changer here, was the simultaneous acquisition of Twispay, legally operating as Capital Financial Services SA. You see, Twispay wasn't some flashy crypto startup. It was an established, fully regulated European financial institution. By integrating these two entirely different entities, they successfully formed the unified xMoney ecosystem. Now, the crucial point here is what owning Twispay actually gave them. It gave them an electronic money institution, or EMI license, directly supervised by the National Bank of Romania. This is an absolutely massive strategic moat. Under European directives, an EMI is an authorized financial institution sitting right within the central banking hierarchy. Having this license grants xMoney the power of EMI passporting, meaning they can legally provide financial services across all 27 European Union member states. It also allows them to issue dedicated virtual IBANs directly to their business users. The takeaway here? They no longer have to beg a partner bank for permission to move fiat money. They have direct access to the clearing rails themselves. This unique architecture powers what is known as the dual-rail engine topology. Let's unpack what that actually means. On one rail, you have the traditional fiat rail, operated by their EMI license to the National Bank of Romania. Because they are the licensed institution, commercial banks cannot arbitrarily freeze xMoney's segregated customer funds without proving actual statutory breaches. This completely eliminates that threat of banking de-risking we talked about earlier. Then, on the parallel rail, you have the Web3 crypto processing side. This is managed by specialized virtual asset service providers, or VASPs, registered in Portugal and Estonia, and they handle all the crypto acceptance, the multi-chain swaps, and the strict anti-money laundering screening. For the merchant using this, all this incredible back-end complexity is distilled down into a single, highly elegant tool, the dual-rail checkout widget. It works in 4 steps. Step 1, a unified API checkout widget just loads on the merchant's website. Step 2, the customer can seamlessly select traditional credit cards, Apple Pay, Google Pay, or digital assets like Bitcoin, Ethereum, and stablecoins, all side by side. Step 3, if the customer chooses crypto, xMoney instantly activates a proprietary 15-minute locked exchange rate, so the consumer pays a fixed rate and xMoney's engine absorbs all that micro-volatility risk in the background. And Step 4, instant settlement. Once it's on-chain, settlement finality is absolute. There's zero chargeback fraud risk, absolutely no 180-day rolling reserves, and the merchant can receive their instant payouts in fiat or stablecoins, completely bypassing those legacy wire clearing networks. But just as this Trojan horse was fully assembled inside the gates of traditional finance, the entire landscape shifted dramatically. The European Union introduced MiCA, the Markets in Crypto Assets Regulation. This was a massive structural realignment of the laws governing digital money. So the million-dollar question is, did MiCA destroy xMoney's regulatory arbitrage, or did it actually transform their EMI license into an impenetrable continent-wide monopoly? And how exactly does their 1% take rate fundamentally alter the unit economics of global commerce? You will definitely want to see the financial modeling on this. Thank you for joining the Praxeum for part 1 of this explainer. You'll want to stick around for part 2, where we break down the MiCA compliance moat and the multi-chain tokenomics that make this whole engine run. See you there.